Hello everyone, Nagaraj Annaiah here, Bay Area Realtor and investor, and welcome back to the Real Estate Show. Today we are going deep on the big beautiful bill, yes, the tax and the spending package just signed by Mr. President Trump on July 4, 2025. Hello Elder, welcome to the show.
Thank you for having me, Nagaraj.
Yeah, today we are going to break down what is the sweeping regulation means for your pocket, whether you're flipping homes, renting your property, or managing small business income. There's a lot to talk about it. Elder, so let's talk about the new things what the Trump administration has brought in so that we can talk about more on that.
Definitely, definitely. So, I mean, the big beautiful bill did implement a lot of changes. It also made a lot of things permanent. So, all the Trump tax cuts from the first bill from 2017 are all now permanent. Also, the standard deduction has increased. So that'll be ongoing for a while as well.
Mhm.
Bonus depreciation will be 100% forever, which will be amazing.
Wow.
There's also a lot of different things too, like the salt cap increase. There's Trump accounts for kids. But yeah, overall, a lot of changes. A lot of changes.
I think first let's start about what does making the 2017 individual tax cuts permanent mean for homeowners and investors.
Definitely, yeah. So 100% bonus depreciation will be huge. So depending on where you are buying a property, you could pretty potentially write off your entire down payment, assuming you put 20% down. If you're buying a vacation home, you could potentially write off even more than what you contribute. So I think real estate investing will continue to get hotter and hotter due
Mhm.
to this massive permanent change.
So just to quick thing about that, right? Like basically, if somebody is buying in a real estate investment, is they should do the short-term rental loophole to qualify for this, or how do they qualify for these tax cuts?
So you can either be, if you're not a full-time real estate investor or a real estate
Mhm.
professional, short-term rental loophole would work for you,
Mhm.
whether you buy a new home or use your existing home. Or if you are a real estate professional, like let's say you're a full-time realtor or full-time investor, then you
Mhm.
can buy a long-term property, mid-term property, really any property in the States.
Okay, they just qualify for instead of waiting for 27 years, go do it and you get it for a all that down payment you can qualify for it. Tax rate.
So when you buy an investment property, you have to do a cost seg study. The cost seg
Right.
study will determine what assets are eligible for bonus depreciation. That is any asset below a 5 or a 15-year useful life. It's usually about 20 or 30%, somewhere in that range
Mhm.
of the property's basis.
Okay. And one more important bill what you talked about is new salt deduction cap, right? The salt deduction cap just jumped from 10K to 40K through 2029. How does that impact high tax states, especially like Bay Area and like California, tax states like California, and especially Bay Area cities, San Jose, Santa Clara, Mountain View, that areas and all, right? Because our property prices are so high always.
Yes, so this is huge, huge, huge for Bay Area homeowners,
Mhm.
or anyone who's actually working in the Bay Area. So
Mhm.
if you're in the SF Bay Area, you have very high property tax, and you also have very high state income tax. So
Mhm.
before this law, you could only deduct $10,000 of property tax and income tax. I bet you a lot of our listeners pay over 10K in property tax alone,
Mhm.
not even including the state income tax. So this has increased the cap to 40,000. So you can write off way more of your property tax and state income tax. So if you're looking to buy a newer home, this would be a great, great year to do it.
So basically, a lot of people calculate. I speak to a lot of first-time home buyers and or the second-time home buyers, right? They always include their property taxes during the calculation. They say, Nagaraj, it's 7,000 a month more. No, I can't qualify. I don't want to do it because they always do the wrong math. I keep telling on them there's a cap always from 10K to 40K. Dude, if you're looking around, then you can qualify for more instead of just looking for like why are you including your property taxes? That's a wrong way to think about it.
Exactly. So property tax and interest are tax deductible. So if your property tax is 10K, it's not actually 10K, depending on your bracket. Let's say you're in the top bracket, if you're paying 10K in property tax, it's actually more like 6,000 because you're writing that property tax off of your tax bill.
Yeah. So basically, if somebody is getting a 200K and if they're paying a 20K in property taxes, so basically their income is like now reduced 200 minus 20. So that, yeah, and again, 2000, 3000 in insurances also. Basically, their income is reduced to 177, right? So in that one, roughly they can save around, if they're in 30% tax bracket, they can save around 6,000 roughly.
Exactly. And you also got to include interest as well. You will
Yeah.
deduct the interest payments too.
Interest is still the 750K, right? 750K interest, that's not changed.
Correct.
Yeah. So one more important thing to talk about is deduction for tips plus overtime, right? How will the new deduction for tips and overtime for the those earning in less than 150K affect taxable income for?
Correct. 150K single, 300K married filing jointly. So if you are in those ranges, the first $25,000 of your income, be it whether it's tips or overtime, will be tax exempt on a federal level.
Wow.
You'll still pay payroll tax, you'll still pay state income tax, but you will not pay any federal tax on that. There is a phase out. So even if you are married filing jointly, you make above 300,000 there is a phase out. So you have to make, I think, above 450K to be fully phased out. So I mean, plenty of people will still get the benefit.
I think better to take more tips then, right? Like all your incomes, maybe change it to a tips. That's a lot better then.
Exactly, exactly. So I mean, depending on how you structure yourself, if you're a business owner,
Hmm.
$25,000 of tips can be tax free for you.
Listeners, see, these are the things when you miss out a lot of time because if you're not talking to expert, then this is what you all miss it out. Because a lot of my clients, right, they keep on telling me, Nagaraj, I'm paying a lot of taxes. I'm not paying a lot of taxes. And they have investment properties also. Then that is where they need to discuss more on the bonus depreciation in section 179, which we discussed. That this bill restores like 100% bonus depreciation for commercial real estate and production property. What does, like we talked about the investors and small business, anything else where they can want this bonus depreciation need to talk about?
So it actually applies to any kind of business asset. So I mean, if you're buying, let's say, you run like a coffee shop and you want to buy a brand new coffee machine for $20,000, you can buy it and deduct the whole entire thing in the year that you purchase it. So
In
it really
the
applies to
same
pretty much,
year,
pardon?
in the same year you can deduct it.
Correct.
See? So if you go buy 50,000 related laptop, then you can qualify for it, write-offs, right?
Right.
Listeners, then what else? Like this is the best time to do in the businesses. And I think if you're doing a real estate investment also, right? And if you're buying something for the property as an investment, like maybe a countertops or something else, all that can be, all the upgrades can be waived off then here at one time.
Exactly. And I just want to stress some other things too. There are some what I would call like detriments of the tax bill as well. One of them is the reduction of solar credits and EV credits. So if you want to get solar on your primary home, do
Mhm.
it this year or next year. If you want to buy an EV, do
Mhm.
it this year because in a couple of years, all of the EV and solar credits will be fully gone.
So there will be no clean energy credits, right? Like that's completely going to be eliminated.
Correct.
Wow. So then the Tesla and other EVs will be watch out for them, right? So I think somehow it's going to impact a lot of electric cars. Then we should watch out for that then.
Exactly. Exactly. Yeah, I would assume that in a couple of years, solar really won't be as popular. EVs really won't be as popular anymore, just because all the tax advantages will be fully gone.
So how is going to impact, especially California, because Newsman, the governor had mentioned by 2045, he wants to have all the EV cars in around. But now what we are seeing is completely a difference. What's going to happen now?
Correct. On a federal level, we're kind of seeing the push against clean energy, but
Mhm.
states can still do their own thing, right?
Yeah.
California can still do like a state credit or a state incentive to incentivize solar and EV programs.
Yeah, but no, it's not going to have much credit then because federal was contributing a lot, and now if it's only a statement, we need to watch out for it. I think it's going to have that is where Mr. Elon Musk was talking about the third party, right? Like need to watch out the things how it's going to. And now let's talk about the QBI deductions, right? The qualified business income deductions is now permanent and expanded to a 23%. How can a self-employed agents or LLC optimize it?
Definitely, yeah. So a QBI is an automatic deduction. Anyone with a small business gets this deduction.
Mm.
So if not having a business or a side hustle that makes sense a couple years ago, it really, really makes sense now. Basically, we're seeing a giant trend towards taxing businesses and investors way, way less. So if you are a W-2 worker, there really is no reason why you shouldn't have a small business or a side hustle next to your W-2. The tax benefits are going to be very, very good for those.
Wow. Okay. So what about the estate and gift tax exemption, like estate exclusion now like 13.99 million for individuals, 27.98 million for couples, rising to a 15 million and the 30 million. What this means for the legacy planning?
Definitely, yeah. So there are two types of taxes when a person passes away. There's the federal inheritance tax, and there's also the state inheritance tax. California actually doesn't have an inheritance tax,
Mhm.
so that's actually very good for California. And
Mhm.
on the federal level, you could potentially pass on almost 28 million of wealth to your kids
Mhm.
tax free. But it's very important to structure this ahead of time. Remember,
Mhm.
tax laws can change at any time.
Mhm.
So if you're in your 70s or 80s, you can actually form a trust today and start
Mhm.
going against the inheritance exclusion while you're still alive. Because
Mhm.
let's say in 4 years with a new change in tax policy, they might lower that way, way down. So I mean, if you're in your 70s or 80s, this is a great, great time to do estate planning for your heirs.
Okay, that's a good bill then, right? What about a 1031 like kind exchanges? Note, which is really a lot of people were thinking about they will stop in the 1031 exchanges. But good thing is no changes to section 1031 exchange. Is this still your go-to strategy to defer capital gains for the 1031?
100%. So, I mean, real estate is really the only appreciating asset you can buy, you can sell
Mhm.
without incurring any capital gains, right? If you buy a stock, the stock goes up, you sell the stock, you pay tax. Can't avoid that. If you buy a house today, sell it 20 years later for double, triple the price, you can avoid the entire tax as long as you buy a property of similar value. And then, best thing, when you pass away, your kids will receive that property and all the tax that you deferred goes away.
Wow, man. I think that's what a lot of people doesn't know how the 1031 also works out. They can always, when they're buying investment properties, selling the investment properties, make sure you're using a 1031 because it's nothing to lose. And to set up a 1031 exchange when you're selling it, it cost you $1,000 or something to to create in a 1031 account. So that way, watch out. And if you need more details about a 1031 exchange, how it works, do reach out to me. I have an experts and I can introduce to them. So see, so you make sure you're benefiting on all these things, right? So
Exactly. And then also just to add on a 1031 exchange, you actually realize you're getting tax free, right? When you buy that house or that new property, you will refinance it and you will pull out that entire debt tax free. So, I mean, you still get to enjoy the benefits just without any of the tax.
yeah, I think that's a great thing, right? Like, see, when you, as you said, I think a lot of people miss out. They just concentrate on stocks, but they're not diversifying their portfolios. One of the things, because stocks can go up and down. There are some stocks keeps going up already. And that is the time you need to just diversify. So that way, whenever this is just you're keeping on the property. So that way, when it goes up, also you can sell it and buy something else. And a lot of for the flippers also, right? This is the way to go about it. Basically, you're doubling up on money, tripling up on money, right? Just do this at 1031 exchange way, so that way it works out for them.
So for flipping, you can't do a 1031. 1031 can only be done on an investment property. But with flippers, you want to keep a couple houses every single year,
Mhm.
bonus depreciate those, and
Yeah.
offset the income from your flips with bonus depreciation.
And I think that's a good thing you told me now. I think I would like to quickly talk about if somebody is doing a bonus depreciation, can they still do a 1031 exchange or no?
Yes,
They can do it, right? Yeah.
exactly. So you let's say you buy a house this year for $1 million. You
Uh-huh.
bonus depreciate it, you get $200,000 off of your taxable bill.
Correct.
And then after 5 years, the property value goes up. You can 1031 exchange it, and you'll defer the bonus depreciation recapture and all of the capital gains.
Wow. And I think one more important thing to talk about is foreign investment tax. Newly proposed 20% foreign investor without holding a tax, will this impact real estate demand for overseas buyers?
So I don't know. I think as long as the cash stays in the USA, there really won't be much impact. There is a remittance tax though, which would be huge.
Mhm.
It's a 1% remittance tax on money sent abroad. So
Mhm.
if you're a foreign investor and you're investing in the States and you want to pull that money out of the States, expect a 1% additional tax.
But it might impact to the new buyers coming in, or somebody is like, maybe a new buyers might not be scared of this. I think it's because only when they're pulling off the money, then it's going to impact.
Exactly, exactly. So it really depends on what is your intent with the investment,
Mhm.
and do you want to cash that money out of the States or do you want to leave it in the States?
Okay. And one last thing, what about the audit and compliance alerts? With this sweeping tax changes, where should real estate, like if somebody is like real estate investors, small business owners, be extra careful?
So definitely, I mean, you definitely want to, cross your T's, dot your I's.
Uh-huh.
Whenever there are new changes, especially changes this big,
Mhm.
not everyone understands them and not everyone implements them correctly. So I think it's very important to talk to a professional, build a game plan, and make sure what you're doing is actually complicit with the current law passed.
Yeah, because especially we talked so much about the salt, where it is like up to a 40K of your tax for property taxes, bonus depreciation. Because salt, especially, there was a lot of people were thinking about they'll cap off to 500K income. That they didn't put it in, which is really good, right? And deductions for a tips or a overtime. It's more of a complicated. That is where the experts like you makes a difference, correct? So setting up a call with you is a free consultation. So if somebody wants to reach out to the CPA dude, what's the best way to reach out?
Definitely, yeah. Just go to join.thecpadude.com, join.thecpadude.com.
Mhm.
You can book your free consultation call with us, and then we'll see how we can help you from a tax perspective.
Okay, listeners, if you want to reach out to me, it's easy. Go to nagarajhomes.com, nagarajhomes.com. Click on a WhatsApp icon. That's the easiest way to set up a free consultation with me. If you're buying, selling, or investing on the real estate, before making any decisions, do reach out to me. It's a free consultation. A lot of people are reaching out to me. They get a free advice so that it can make a real benefit for you, especially tax and the real estate goes hand in hand. It needs to be planned properly. If you don't plan properly, you don't can't build your wealth. Building a wealth is not happening one generation, it's generations to generations. That is the way all the wealths have been built. So you need to have a proper experts to help you out. That is where we make a difference. Thank you so much for listening in. Keep tuned. Thank you, Elder.
Thank you for having me, Nagaraj.
Thank you.